here are a few housekeeping items. This webinar is being recorded. The recording will be available on our website. Any resources mentioned during the presentation will also be available on our website. All attendees are muted. If you are having any issues with audio, you may need to click on the webinar screen to enable it. We welcome questions. Please use the Q&A box located at the bottom of your screen to submit questions, and we will answer them at the end of the presentation. The mission of San Pablo Economic Development Corporation is to act as the catalyst for equitable economic opportunities. The SPDC offers workshops, training, and classes for businesses, entrepreneurs, and individuals. To support advancement, we focus on employment training and support, business resources and access to capital, and home ownership, which we are going to discuss on this webinar. This webinar was possible with the help of our wonderful partners, Envirod and Jazz Lopez. We are grateful for their partnership and collaboration with SPDC. Our presenters today are Vanessa is not here, so Marco Rodriguez from Envirod and Jazz Lopez from Golden Star Realty and Loans. Now I turn it over to Marco from Envirod.
All right, well, hello everyone. Thank you so much for tuning in as we make our way to our very first Unlocking Home Ownership webinar this 2024. So it is a pleasure to be here. Hopefully everybody is nice and dry out there. There's a lot of rain going on. So let's go ahead and dive deep. Next slide, please. Just wanted to say a little bit about who we are. Somebody had said about my wife, Vanessa. That is my business partner. Unfortunately, she's not able to be with us today, but just wanted to give you a little bit of information who we are. So we both are here Richmond residents. You know, we live and breathe Richmond, San Pablo. We've been in business for over 20 years. I got licensed in 2003. This May 3rd is going to be my 21st anniversary here in real estate. Vanessa's been in real estate since 2005, so it's pretty much a husband and wife team that compiled the Envirod team. We've helped over 650 families over the course of the last 20 years. So we're very proud of it. So yeah, this is just a little bit about what we do. And our mission is to be able to provide all of our clients with a pleasant and transparent experience. So whether you're a first-time buyer, move-up buyer, or just wanting to get more information, get educated on the process, that is something that we tend to like to do with all of our clients. Next slide, please. Step number one, when you go into homeownership, there's a lot of different components, a lot of different steps. The very first one is you have to see the benefit of being a homeowner. There's so many advantages. Obviously, renting is an option. But if you look at homeownership, there's many advantages. Like, for instance, number one, there is appreciation when you buy a house. Over time, we've seen that even though markets, they go up, they go down, they get a little soft and they settle. Typically, over time, properties tend to appreciate. So that's one of the biggest reasons why we are big advocates for homeownership. Number two, there's also a lot of tax advantages. Right now, a lot of people that are renting, unfortunately, are not able to have a lot of write-offs. When you are a homeowner, you can write off things like property taxes, the insurance, the interest that's being paid to the bank, and so forth. So there is a lot of different benefits of being a homeowner. And number three is also building equity. Over time, even if the market is the same, you know, here to 20 years and the market is still exactly the same, because you're paying down interest and your principal each and every month, every year, it's going to go down. So over time, you're going to be able to build equity into your home. So that is why looking into being a homeowner is very important. The second thing that we want to talk about this, I don't know if it's evening, it's 5:07, we're going to say it's evening, are the emotional and the psychological advantages of having your own place. For instance, number one, having a sense of stability, just knowing that the landlord cannot come in and just say, hey, you know, 30 days, 60 days, you have to vacate this unit because we're going to go ahead and we're going to sell it, or we just want you to, you know, to move out, or because we're going to move in our kids or a family member, things of that nature. That is something that you, as a tenant, you're going to be kind of left up in the air. When you have your own home, that gives you a sense of stability, because you know that as long as you're living in the property, making those mortgage payments, you're going to be there for whatever time you want to be in that property, you know. Also, creating a legacy for your future generations. This is something very huge, especially, you know, let's say as we get older, we want to be able to pass something on to our family, to our kids. Why not be able to pass something very, very important like real estate, where over time, maybe, you know, we've been able to pay off the house in, you know, 25 or 30 years. Now we have something that we can give to our kids, you know, or to our family. So we can create, in a sense, some type of legacy for them. So through real estate, we're able to kind of build wealth for our future generations. So that's another reason why this is very emotional and it has great advantages and also a sense of privacy and freedom. You know, one of the great things about being a homeowner is that you have that privacy where you know that your space is your space. If you want to have dogs, you want to have cats, you want to have a sense of privacy, you want to start building things within your home, you're able to do these things when versus when you're renting, unfortunately, there's a lot of things that you are not able to do. So it also gives you that sense of having that freedom as well. Because when you're in a home, you're able to kind of make it your own, give it your own personal touch. So you have that freedom to do a lot of things. When you're renting, unfortunately, you have to ask permission from the landlord, from the property management to be able to make these changes. So it does have a lot of emotional and psychological advantages to have your very own home. Next slide, please. We also have to determine a realistic budget for homeownership. And this is what I mean. You have to make sure that you are in a position to be able to purchase. You don't need a lot of money down. You know, there's this myth that you have to have 20% down. And I know Joss is going to go ahead and touch on some of the different products that she can offer. However, one of the things that you have to keep in mind is that you do need a little bit of money to be able to put as a down payment, because there is the down payment and there's also something we call closing costs. Closing costs are everything that's associated with the purchase of the home. So when you have a realistic budget, you've been saving for some time, it is good to know that there's a lot of options out there. You don't have to put that big chunk down, that 20, 25, 30% down. There's a lot of great products that you can use and a lot of products that are forthcoming that you can take advantage to be able to make this a reality. Then the other thing too is you want to make sure that you are very conscious of your monthly mortgage payment. So this is what I mean. A lot of people can get qualified for a certain amount. So let's just use for an example, $700,000, right? $700,000 and your mortgage payment is XYZ. Just because you're able to qualify for that $700,000 does not necessarily mean that you want to buy a house at $700,000, because maybe you feel comfortable with a house at $650,000 or maybe at $600,000. So what you want to do is you want to make sure that you have your numbers, you have your budget, you make sure that you have everything allocated, including your monthly mortgage obligation, to make sure that it does not get in the way of your current lifestyle. What we don't want to do is have someone that are just making ends meet just with this mortgage payment, where it's going to put them in a situation where, like, okay, I didn't really think about this expense or this expense, and then now all of a sudden maybe there's an emergency, and then all of a sudden they're put in a bind. So we want to make sure that you're conscious of your monthly budget, and of course with your monthly mortgage payments. You also have to allocate, when you're thinking about being a homeowner, you have to allocate also, there's going to be repairs. You know, the majority of homes living here in the Bay Area are going to be older homes, unless you buy in a brand new community, of course. They're going to require a little bit of maintenance. So you have to budget for maybe a little bit of electrical or plumbing, or maybe that roof is towards the end of the year of its life. So you just want to make sure that you have funds set aside to be able to make those repairs when the time comes. That's another thing you have to make sure that you budget yourself for. And of course, just having some emergency funds. What you want to do is just, we don't know what's going to happen in life. So you just want to make sure that you do have certain months of emergency funds, just for whatever case, whatever, you know, life throws our way. Next slide, please. Oh, I'm sorry. Go back one slide. Missed the point. Sorry. Back one.
Okay, so
Oh, no.
how many?
No worries. I'll go
Oh,
through it.
okay.
Through the back, I'll just kind of go through it without the slide. So one of the things too is you want to make sure that you explore your different options, getting pre-approved. You want to make sure that you understand what type of loan product you're going to be using. Is it going to be a conventional loan? Is it going to be an FHA? Is it going to be VA? Are we going to be using grants? What type of loan are you going to be using? So you have to make sure that when you pair yourself up with the right lender, that you ask all these questions, understanding what type of program you qualify for. There's certain benefits and advantages from one product to another. So it's always good to make sure that you're explained and you're told which ones you qualify, and then you can make the overall choice on which one you want to go through. So that's one thing. You also want to make sure that you're able to qualify, because when you're out there house shopping, and we'll go over this in just a little bit, when you're out there house shopping, the very first thing that a seller wants to see from yourself is they want to make sure that you're pre-approved. That's going to give the seller peace of mind that you're able to qualify for that house. That's going to give them the peace of mind that you're able to buy that house. And then that's going to give them the peace of mind to be able to pull that property off the market to be able to offer it to you. So that's another reason why you want to make sure that you're pre-approved. And there's so many different advantages, again, through the different products, which I'm sure Josh will touch in a little bit. I want to just quickly go through the whole home buying process, how this all works. So typically, what we typically recommend is for someone to get with a realtor, someone that they trust, someone that maybe they were referred to, or someone that maybe they like the reviews online and so forth, and have a consultation. We call this a buyer consultation. What you want to do is ask all the questions. As a first-time buyer, there's going to be so many questions that you want to make sure that you get the answers to those questions. Or maybe if you bought a house, but it's been maybe 15 or 20 years since the last time you bought a house, the market has changed, underwriting has changed, the market, everything, the programs, everything has changed. So you want to make sure that you're kind of knowing what's going on in today's market. So consultation is always the best place to start. Second step would be to get pre-approved, to make sure, again, you run the numbers. The bank's going to look at your financial credit, your debts, how much income you're making, and so forth. And then once you're pre-approved, you're going to start looking for those homes. When you find a house and you say, you know, this is the property that I can see myself living, it's got the 3 bedrooms, the 2 baths, got the nice yard, nice kitchen, and so forth, you're going to want to make an offer. So we always recommend for a realtor, someone that you trust can help you and guide you on how to make a great offer. There's so many contract clauses. There's so many contingencies in there. There's so many components to a contract. So we want to make sure that someone can explain everything that you need to know so you understand. Because remember, when you sign off on the contract, it is a legal binding contract. So it's something that you want to make sure that you understand. Once you're in contract, you're going to go ahead and inspect the home, make sure this is the house for you. If it has any red flags, you're going to be able to pull out from the house if needed. But if everything's looking good, you're going to be able to continue to push forward on getting ready to close on that house. Then you're going to meet with your lender, or maybe you're going to be at the title company, or maybe at your home. The documents are going to be with a notary. You're going to sign all your documents right there. You're going to give them some forms of ID. You're going to bring in the amount of money that needs to be given. So this way you can have all your funds, and then you're going to be able to close. And typically that is the process when you're buying a house. Kind of sped through it, but for the time's sake, just wanted to kind of keep it going. And one of the other things that you want to make sure is in regards to a real estate agent, you want to make sure that you hire the right agent, someone that's going to be on your side, someone that's going to be exclusively working for you, that has your best interests at heart. They owe you the fiduciary duty to represent you as best as they can. Typically, certain buyers, they think that the agent that is listing the house, right, for let's say 123 Main Street, there is a agent that is listing that house. They think that they should go to that agent and say, hey, dear agent, I want to purchase this house. But what happens is that agent owes the seller first their fiduciary duty. They represented the seller first. We always recommend to get your own real estate agent. Typically, and again, this is not always, but typically the seller pays for the compensation for the buyer's agent. Now, there's occasions where the sellers will not pay for the buyer's agent's compensation, and then you can have that discussion with the agent and figure something that works for both of you. But for the most part, sellers are also paying for the buyer's agent's compensation. So if you're not paying for it, it is better just to have your own representation, right? Some of the pitfalls that we see some of the clients that have that come into our office is maybe they just had a friend, maybe they had a family member that had a real estate license. They probably figured that because they're their friend or maybe they're because they're family, we should work with them, right? Now, one thing I would caution you is that just remember, sometimes business, friends, business, family does not pan out. And what happens is you already have established a relationship with these people. So what you don't want to do is have maybe the process of business get in the way of your relationship with family or friends. So we always say it's probably best to look for someone that is not a friend or a family, because we've seen it that sometimes it doesn't go well, and then you're going to continue to have these relationships. So you don't want business to get in the way of it. That's one of the pitfalls that we see some of our buyers when they first start off in their journey they can make. The other thing is that when they are buying homes, some of our buyers are buying homes. Maybe in the past, they were probably told to remove contingencies. Maybe they said, this property already has the inspection. They have the termite, they have the roof, they have the home inspection. The house looks like it's in great shape. Why don't we go ahead and buy this house as is? Now, that is great, but the only thing is that did you really look at every single report? Were there any areas that maybe you had any questions on? Because what happens is when you remove contingencies, that means that you're telling the seller, I'm going to buy this house no matter what the condition is. So you have to be very, very careful when you are removing contingencies. Typically, there's 3 contingencies in place, which are inspections to make sure that you have the right to inspect the house. There's the appraisal contingency. That's going to make sure that you're not overpaying for the house. And there is the third one, which is the loan contingency, meaning that you're going to have some time set aside to make sure that your lender can fully approve you for this house. Anytime you waive contingencies, you can put yourself in a situation where it can be costly, because remember, when you're buying a house, you are given a good faith deposit. And when you start removing contingencies, there are risks associated with it. So we always want to make sure that all of our clients, they understand what contingencies are. And if they decide to remove or waive any of these contingencies, they know all the risks that are associated with it. Now, as we move forward, we also have legal and contractual aspects. Understanding contracts, we want to make sure that you understand the entire contract. Our contracts, when you're making an offer, they're over 20 pages long. So we want to make sure that you understand all the clauses, all the risks that are associated with it. We want to make sure all the benefits that are associated in these contracts and everything that goes with it. So with that being said, it's always good to make sure that you have someone that understands contracts. Make sure that there's an agent that has got up to the date training on these contracts, because they're always changing. And also, for instance, San Pablo has its own unique set of ordinances. So you want to make sure that someone that is local. San Pablo has something we call an RH&S inspection. This is an inspection that is only done primarily in the city of San Pablo, not in the unincorporated area, but actually in the city of San Pablo. So you want to make sure someone that is familiar with that. There's also what we call the sewer lateral ordinance. So you just want to make sure that someone understands these ordinances, because they also come to play with our contracts. And overall, just there's going to be a lot of different pitfalls. There's a lot of things that first-time home buyers can make. So we want to make sure is that we minimize all those. Some of them might be something as simple as maybe like red flags on the inspections. Let's say, for instance, there's a termite inspection that was done, but they were not able to get underneath the house. So on the report, what they're going to say, we found that there was no termites in the house. However, we did not go underneath the house. So in other words, they're calling for a further investigation. As a buyer, you want to make sure you pay attention to this, because that can be costly. We've seen that maybe the house didn't have any termites from the inside and out, but all of a sudden the termite inspector goes underneath the house and it can be thousands of dollars. So you want to make sure that you don't fall into that and just assuming that because the house on the outside is good, underneath the house should also be good, right? Sometimes it is, sometimes it isn't. So you want to make sure that you pay attention to that. Also, when you are making offers, you have to be looking into things that maybe could cause a red flag. So like, for instance, if you're buying a house and there is a tenant that is living there, The first thing we have to make sure is that tenant going to leave? Because the last thing you want to do is become a landlord when you first purchase your house. You want to make sure that if you're going to move in, you want to make sure that that house is ready, that it's vacant, and it's ready for you to move right on in. The last thing you want to do, and it's happened to certain buyers before they came with us, is that they purchased homes and they were tenant occupied. And now they become automatically, they are now landlords. Now they have to deal with getting the tenants out. There are ways, but remember that we are in a state where it's rent control, right? So there's a lot of protection for tenants, especially certain cities like Richmond, Berkeley, and Oakland, where they have very strict rent control rules and regulations. So you just want to make sure that before you buy a house, you understand everything that's associated with it to minimize any and all red flags that come your way. Next slide, please. And that is the end of my presentation. This is our information. If you would like to get a hold of myself or Vanessa, you can reach us at our phone number there or via email. And I want to go ahead and now turn it over to Ms. Joss Lopez that's going to go ahead and cover the part with credit and financing and all that fun stuff.
Thank you, Marco, for all the great information you just provided us with. Hi, everyone. Thank you so much for participating in this webinar, Unlocking Homeownership. Today, I'll be specifically talking about credit repair and mortgages. My name is Joss Lopez. I am a broker associate for Golden Sun Realty and Loans. Next slide, please. A little bit more about me. I have a Bachelor's of Science degree in Managerial Economics from the University of California, Davis. I have been in real estate industry for about 10 years. I'm licensed in both the Department of Real Estate and the National Mortgage Licensing System. I'm a notary public, and I am currently working on becoming a certified residential underwriter, which I'm focused on completing by the end of 2024. Next slide, please. First, let's begin understanding what credit is. Creditors use credit to measure a consumer's ability to responsibly repay a debt as agreed by all parties. Numerically, we measure credit as a FICO score, which is the odds that an individual will default in 90 days or more on a credit card or loan that you obtain with a creditor. FICO scores range anywhere from 300 to 850, and this depends on each credit bureau. And each bureau has a different algorithm that they use to determine this score. Credit scores are also weighed based on a scorecard, and scorecards have about 15 to 20 characteristics. For example, 30-day lates will be assessed differently than 60 or 90-day lates. Next slide, please. Why do you need good credit? In this country, we are heavily dependent on credit to help us obtain financing for home buying. As you can see in my next slide, mortgage insurance could be substantially higher if you are on the lower parameter of the credit range. Higher credit will enable you to get lower interest rates, better financing terms, better approval rates, and have more negotiating power. Next slide, please. Actually, can you please go back to that other slide? Let me touch on this last. Okay, so how lenders look at credit and how credit is weighed. So how lenders look at credit is, sorry, I'm having issues here with my window. Okay, so this slide gives you an overview of what that credit range means to you as a consumer and what it means to the creditor. To you as a consumer, it dictates interest rate and how much you'll pay in financing terms. If we look at the fourth row down on the left table, out of every 47 consumers with a credit score between 620 to 679 on average, one will default. Ideally, you want to be in the first two categories. And based on experience, most individuals have between 720 and 799 credit scores. The image on the right depicts how scores are weighted The two factors weighted the most are payment history at 35% and credit utilization at 30%. Next slide, please.
You're muted, Jess.
How does credit impact consumers? I created this loan scenario based on current market conditions and mortgage pricing as of a few days ago. If we were to obtain a conventional 30-year fixed mortgage and your purchase price is $700,000, for example, with a 3% down payment, your loan balance will be $679,000. As you can see, we have two borrowers, Amy and John. Amy has a credit score of 750 and John has a credit score of 620. They both pay $4,890 in principal and interest, and their interest rate pricing remained the same. However, because John has a 620 credit score, he pays $713 more than Amy. Amy pays $170 a month more for mortgage insurance, while John pays $833. After year one, he will have paid $8,556 more than Amy. If John were to keep this loan for 30 years, he will have paid $256,680 more than Amy. Of course, most of you are not going to refinance or sell your house before the 30-year period, which will alleviate some of these additional costs. Next slide, please. The legalities of credit. There's a misconception that credit reporting cannot be removed or deleted. Credit repair is completely legal in all 50 states. According to the Federal Trade Commission, 1 in 5 people have an error on at least one of their credit reports, and other sources showcase as much as 34% reporting errors. The fact is that credit bureaus are not government agencies, and reporting to them is completely optional. Experian, Equifax, and TransUnion are private enterprises. This means that credit card companies, mortgage companies, and other entities with your payment history do not have to report your information to the bureaus. Thanks to a law enacted on December 4th, 2003 by former President Bush, you have the right to a free credit report per year from each credit bureau. You want to order your report by mail because using the online credit dispute system puts serious limitations on your credit rights with limited statutes. This is because you waive important consumer rights by agreeing to their terms and conditions. The electronic online system for correct and accurate reporting was created by the credit bureaus for their own purposes to quickly eliminate disputes, not in the best interest of consumers, unfortunately. When was the last time you saw your phone payment history or utility bill history on your credit report? I don't remember a time I've seen anything like that on mine, with the exception of your bill being late or sent to collections. This is because reporting costs are expensive and they don't report unless you have defaulted into collections. The reason why your FICO varies from one bureau to the next is because companies want to save money on reporting costs. Next slide, please. So now we are moving into tips on how to raise your credit score. To the left are general rules of thumb for improving credit. Start by making sure you pay down balances on your credit cards. In some cases, maybe you don't have the funds to pay down your balances. So you will want to call your creditor and request a credit limit increase. Since you're making the effort to call them, I encourage requesting a 2x increase. They have algorithms to determine how much you should get depending upon your credit use, and they will ultimately use that to determine your limit. For managing high balances, you might want to distribute amounts to other credit cards that you have open in order to maintain a lower credit balance to credit limit ratio. Student loans are also important to pay down to below the original debt amount. Please continue to use your old credit cards because you don't want creditors to close the account for non-use. Remember, we're trying to optimize for high for a high score as much as possible. And 35% of our credit is comprised of credit history, as you saw in the previous slide. So we don't want those old credit cards closing. If you have plenty of credit established, avoid opening new credit cards. Easy things to do to take unnecessary stress away from setting up automatic payments is to ensure your payments are never late and avoiding finance companies for any high interest loans. Moving to the right, how do we get that coveted plus credit score? First, we want to make sure there are 3 to 5 active credit cards that have been open for at least 3 years. As of the past 7 years, we don't want any late payments, whether they be mortgages, credit cards, collections, charge-offs, judgments, liens, etc. For the past 10 years, there should be no bankruptcies or foreclosures on your credit profile. Your credit card utilization should also be 30% or less, ideally 10, but let's be realistic. Some of us need to carry more debt than others. So for those that do, keep in mind that if you can have utilization below 10%, even better. If you borrow $10,000 from a creditor, you want to have no more than $3,000 owed to them, for example. That would be a 30% utilization rate. You want to show stability by having 1 or 2 addresses, only one form of your name listed on your credit report. Sometimes credit reports have a myriad of names listed, or variety, name varieties, or AKAs, also known as, and you don't want that on your credit report because it doesn't show stability. Or sometimes, credit bureaus can report other people's information on your credit report, and you want to avoid that as much as possible. Do not share your credit cards with anyone except if you're married. You want to reduce your chances of reckless spending. The person liable is the one whose name is on the card. Keep that in mind. And finally, avoid co-signing on a loan, credit card, auto financing, or any other financial obligation. Next slide, please. Once you received your credit score, your credit report, you want to look for any errors. First, look at general information. No more than 1 name variation on your account. Remember, you only have 1 legal name. Whatever is on your California ID or state license ID, Social Security or passport, that's your name. No other variations. No more than 1 or 2 addresses. You want to showcase consistency by deleting any, multiple addresses that may be associated with your name. If you have late payments, make sure that it was reported correctly. Look at the date, balance, and account number. If you have any collections on your report, make sure the account number belongs to you. Is it the correct account number? Oftentimes, it's not. So we want to look for these, little potential errors on our records. Look at the last reporting date with the creditor. If recent, you want to call and negotiate payment. If the collection has already been paid, does your report reflect that it hasn't? And if it does, then you should consider disputing it. If you have a charge off on your account, you have to ensure that it's accurate. Again, you want to look at the reporting date, the balance. You want to make sure that the creditor it's coming from the original creditor. It's the correct creditor. And if you have grounds to dispute, I highly advise you to do so. Next slide, please. We made it to the end of the credit repair section of this webinar. And just to quickly recap, we talked about what a FICO score is and how it's calculated, why it's important to have good credit, things you can do to improve your credit score, and finally, what to do should you find errors on your credit report. Next slide, please. Moving into mortgages. Okay, so what does the loan approval process look like? The first step is to fill out a loan application with a lender. You must show a 2-year employment history. That's very important. Job hopping will not get you approved. That means, you know, if you've been changing jobs in trades every couple months, that will not work. The documentation that you will be requested is 1 month of pay stubs, 2 years of tax returns, 2 years of W-2s, or 1099s if you're self-employed, 2 most recent bank statements, and of course, we will have to pull your credit. To obtain an accurate loan estimate, the lender will always request to pull your credit. So keep that in mind. And if you want to shop around for the to the best possible rate, keep in mind that you have 14 to 45 days. I would keep it more closer to the 14-day period. I have seen, you know, records taking a ding after that 14-day period. It's really hard to say. The algorithm is very, you know, it's very nuanced. So keep that in mind. Next slide, please. Okay, so right now I'm going to talk about the different, well, the most common loan types, which is conventional, FHA, and USDA. USDA being the least common of the three. Conventional, for instance, is the loan everybody wants to be in long-term. Conventional loans allows you to put 3% down payment, but you have to qualify with your income in order to do that with Home Possible and Home Ready. The good thing with conventional loans is that you have no mortgage insurance shall you put 20% down payment. There are flexible terms, fixed rate versus adjustable rate mortgages, and you can choose between a 15-year and a 30-year term. It's a great part. The downside of conventional is that it has a higher down payment typically if you want no mortgage insurance. But if you don't qualify for a 3% down payment, then the minimum would be 5% down. And typically you need a higher credit and income limit. And PMI typically is required for the lower, for low down payment, well, for less than 20% down. And that's prorated based upon how much down payment you provide to the bank. An FHA loan. The great thing about FHA loan is that it's not income dependent. You can get an FHA loan with 3.5% down. And it's easier to qualify oftentimes because it does allow you to have a lower credit score and higher debt to income ratios. So this is a great loan product for folks above the 50% threshold of conventional. And the cons of FHA is that there's mortgage insurance, and the mortgage insurance stays on your loan for life. And there are lower borrowing limits. What does that mean? That means that every lender, well, sorry, every county has stipulated their average median income, and you will have to go based on what the county requirement is for your county. And it has strict property requirements as well. For instance, if your roof has 0 life, chances are the FHA will not be able to fund your loan. So it's one of the a few of the cons of obtaining an FHA loan. The USDA being the least popular of the two has great terms, assuming you qualify. So this program has no down payment requirement, which means you can put we can do 100% financing. Oftentimes lower, your interest rates are lower than your regular conventional FHA loan. The no mortgage insurance also, which is great, and more flexible credit requirements on this program. The cons, strict income limits. So very few people do qualify for these types of loans. And another con is that the entire household income is going to be calculated to determine if the file qualifies for this type of program, and it's also location restricted. So again, the house has to be classified rural for you to be able to obtain a USDA loan product. And funding availability also and processing times can vary. Next slide, please. So Cal Plus conventional and Cal Plus FHA follow the same guidelines as regular conventional and regular FHA loans. The only difference with this loan product type is that you can use My Home, which is a down payment assistance program of 1 to 3%. And you can also use ZIP, which is a closing cost assistance program. Honestly, my advice to you would be to come up with your own down payment, because if you do choose to go this route, you're going to be paying a higher interest rate. And sometimes it may not be worth it. It just really depends, because the market's very dynamic and things change quickly. Sometimes things, maybe one loan product will be great for you today, but not tomorrow. It's that dynamic. So just keep that in mind. And one more thing to keep in mind with My Home and the ZIP program, with the zero interest program, that's what it stands for, is that this is not a grant. And these are funds that you do have to pay back when you sell or refinance your home. Next slide, please. And we have, now we're moving on to mortgage rate buy downs. This was a program I used heavily in 2023. We're still using it now, and we're just kind of seeing what the market does. And, you know, we'll decide if we're going to continue on using this program or not. But just to give you a little overview, I provided an example here. This is a 2-1 buy down example here on image 3, as you can see. So the loan parameters are as follows. Purchase price, let's say your purchase price is $700,000. You put 3.5% down. Your loan balance is $675,500. In a regular world, if you obtain an interest rate of 6.5% for 30-year period, your monthly interest and principal is going to be $4,736. And keep in mind, this does not include property taxes and insurance. So it's just principal and interest. So at the bottom here on the screen, you can see the 2-1 buy down chart. And just to explain to you how this works. So year 1, you get you're going to pay for 12 consecutive months, 4.5% interest rate versus your full no rate at 6.5%, as depicted on the top left image. So if you can, and that's for year 1. For year 2, you're going to pay 1% less than the 6.5%. So you're going to be paying 5.5%. Your note rate still remains the same. It's $4,736, but because you're going to be paying the lesser amount on year 1, the 4.5% interest rate, your buy down payment is going to be $3,889. I'm sorry, excuse me for that. And on year 2, your payment is going to be $4,302. So moving on to the right, your monthly savings are as follows: $846 for 12 consecutive months for year 1, and $434 for year 2. This is a great program for those of you who are waiting to get to a lower interest rate mortgage. It's also great for those of you who know you're going to be perhaps moving in the next 3 years or so, or you for sure know you're going to refinance in the next 3 years or so. I mean, there are myriad situations where this is actually applicable. So this was a great program, like I mentioned, in 2023. I still recommend it today. And the funds do come from seller concessions. So the property you are interested in, would have to, well, the seller would have to help us out with these concessions. And maybe if you have any additional questions about how seller concessions work, you may want to reach out to Marco and he can explain that to you further. Next slide, please. Okay, so finally, we got to the highly coveted Dream for All shared appreciation program that everyone has been waiting for. The lending guidelines just got released Thursday, this last Thursday, January 18th. And these are the requirements for you to be able to apply. You need to be considered a first-time home buyer and meet first generation buyer definition. Unfortunately, the first generation buyer definition is still being worked on by the program, so we don't know exactly what that means. And we'll have, you know, they'll notify us as soon as they determine what definition they're going to be used for that. All occupants must reside in the property. There are no co-borrowers or co-signers allowed in this program, and there's a repayment cap at 2.5 times the amount originally borrowed. The program rolls out March or April of this year. This is a little confusing probably for a lot of you to understand, and I highly advise you to reach out to me with any questions that you may have. And also wanted to touch on the fact that this particular program is only going to allow you for a maximum 95% loan to value. This is a little bit different from the first rollout of the program in that means for you that the maximum amount you can put from your own funds to reduce that principal balance is 5% of the purchase price. Another caveat and another difference from the previous program is that the program is allowing no more than $150,000 of help. So this means that your maximum purchase price cannot exceed $750,000 if you want that 100%. You want 100% of the funds. So it is different from the previous rollout in that way. But the good news is that a lot of you will be able to qualify, whereas before a lot of people who actually needed those funds couldn't qualify, and people who could get a regular loan did qualify. So they had to make a lot of different adjustments to this program as a result of that. They want to really, really make sure that the people who need this program are the ones taking advantage of the program. So next slide, please. We have reached the end of loan programs. And let's recap what we have discussed. We talked about regular conventional FHA and USDA programs, Cal Plus conventional and Cal Plus FHA. With My Home and Zip programs, we know what a mortgage rate buy down is and the highly anticipated Dream for All shared equity program. Next slide, please. So I know I have touched on a lot of information here, and you might be overwhelmed, totally normal. But credit repair and mortgages are very nuanced, and you should take the time to consult with a professional. I am making myself available, so please, please, please know that you can reach out to me anytime with any questions you may have regarding the home buying process. Again, thank you for spending time with us today. And now I guess we can move on to the Q&A section. Debbie?
Thank you for attending our webinar, and once again, thank you to our partner and presenters. We hope this webinar provided you with valuable information. The recording will be available on our website as well as some of the resources and information presented today. Please feel free to contact any of the presenters with any question you may have. Now we are going through the questions on the chat box. So the first question, I think it's for you, Marco. When is the perfect time to buy a house?
That is a great question. So just whenever you feel like it's the right time for you. This is what I always tell folks is there's a lot of people that are always trying to time the market. And what happens is by the time you time the market or by the time you think that it's the best time to buy the house, maybe the market has already shifted. So maybe if you were trying to time the market, you weren't able to participate in what you were trying to achieve. So it really just has to be dependent on when that time is ready for you. You know, some people, they have to move because of jobs, they're being relocated to different areas, or maybe there's something that happened in their life. So if it just makes sense, the numbers make sense, the program makes sense, I just think that's the perfect time for someone to be able to buy a house.
Thank you for the answer. There is also another question for you, Marco. If I find out that there are red flags during the inspection period, can I back out?
Definitely. So that is exactly why it's always good to keep your inspections. Because if you find out something that you were not aware of, so let's say something as simple as the dog that's barking next door, that rooster, is crowing so loud, and you're like, this is kind of a nuance for me, and I just don't want to be dealing with this. You can actually back out. You find out that something happened, someone broke in to the next door neighbor, maybe there's this neighbor that's just very problematic. You can always just use that to be able to back out. So there's many ways, so long as you have your inspection contingency in place. So yes, you're able to do that when you find a red flag.
Thank you for the answer. And just the next question, I think, is for you. The question is, what is the best loan option? Jazz, are you there?
Yes, I'm here.
Okay.
Can you guys see me? Can you hear me?
There we go.
Yes.
Yeah, thanks. Well, that's a loaded question because the best loan program is heavily dependent on each individual's financial circumstance. So there's no perfect loan for any one person, if that makes sense.
Thank you. And we have another question which asks, do I need to get pre-qualified for a mortgage?
Absolutely. You need to get pre-qualified for a mortgage because it's your first step to start shopping for a home. Realtors, more often than not, realtors will want to see a pre-qualification letter, and you want to do a thorough qualification because that way you know exactly what you qualify for, and you're not, just shooting in the dark, not knowing what you qualify for, and then, wasting a lot of time in the process.
Thank you so much. So there is no more question. So if there is no more question, we have reached the end of the webinar. And I hope this webinar was beneficial for you and your question got answered. If you have any more questions, please reach out to me or Marco or Jazz. And thank you again, everyone. And I hope you all have a wonderful day.
Thank you so
Goodbye.
much.
Thank you.
Hi, everybody. Thanks for having us.